Hi everyone. The mood continues to be positive now on oil, which is an interesting change. It's really over the last 3 or 4 weeks that suddenly everybody decided they're quite positive on oil. And it's been quite notable. Couldn't give these things away on the first day of the year, and now everybody seems to be playing a catch-up trade. You know, the Nvidias of the world, AMDs, everything else seem to be sort of topping out. Obviously, we've blown out the Nvidia earnings. The issue there is that at the current rate of growth, there's still more to come. But of course, the market's now beginning to heavily discount future earnings growth. And whilst Nvidia's monopoly looks incredibly powerful, it feels like the market's just beginning to get tired of buying more Nvidia, and as a result is looking for catch-up trades. And a good catch-up trade is to go long oil, especially as Saudi's got control of the market. They're tightening the market. They've continued the cuts into summer, which we expected. And the market tightens naturally into summer. And so as a result, you know, things look pretty good for oil right here. We've also repeatedly said that the oils are doing a much, much better job. Now, of course, this was interesting through results because you saw companies that didn't get the memo on capex, which to me is inexplicable. I mean, I was talking to Diamondback, might have been November last year, and they were saying the conversation is how much we cut. Certainly at dinner with Mike Wirth, CEO of Chevron, and CFO, as was Pierre Breber, after the dinner I privately asked them, what price oil would you cut capex? And they looked at me completely perplexed. I mean, they'd not even considered cutting capex. But you have other companies, and I mentioned Diamondback keeping good control, although of course they then also did a spectacular deal for Endeavor. And a couple of other companies, notably Antero Resources, also Chesapeake showed what could be done with a capex cut. It's not that hard. And of course there were other companies that simply, notably EOG was disappointing. XOM I thought should have done a bit more to cut for 2024. I think they're very sensitive about cutting, having said that, because of the FTC and concerns about tightening oil supply with all these oil deals. So the companies are at pain who are making big acquisitions, I think, to talk down capex cuts. But those, particularly in the gas space, really have no excuse not to be cutting capex. But of course, it's a brutal process because it finds out those who are desperate and those who have a good inventory and are comfortable about waiting for gas prices to recover. We've said that we're sufficiently negative on natural gas to be now concerned about 2025, but the market suddenly got a boost because it seems like EQT, having announced they're going to keep spending, suddenly a couple of days later this week announced that, this is going to be too noisy, announced that they're going to do their own capex cut. So I've not seen that. I can't remember an instance, although we're looking at some precedents of previous capex cuts, voluntary dropping rigs because of bad prices, and we'll be putting that out in the note. There is precedent from companies like Chesapeake. So anyway, the companies, what I'm trying to say is the companies are doing a good job in the environment. They're much better companies, there's less of them, they're much more focused on cash return to shareholders. Their multiples are very low, as we've been through repeatedly. You have around 7% of the market's earnings and around 4% of the market cap, so you're at a 50%, more or less 50% discount to the market. And if earnings start rising, which we're right on the cusp of them doing, as a result of oil prices being higher than forecasts, which we're right on the cusp of happening, you get earnings upgrades and the group starts moving, and that's where we're at. So it's all looking pretty good for oil here. The other big drama, of course, is the late entry of Exxon into the Chevron-Hess deal. A really fascinating game theory. After quite a bit of thought and a few conversations with merger arb specialists, if you back solve for what's Exxon's end game, the theory becomes Exxon's trying to buy Hess. Now, is that too much Hess? It would take them from 75% to 75% ownership of Starbrook from their current 40%. If you add in Hess, it would be 45% of Exxon, 30% of Hess. And historically, that would be considered too much stake for Exxon, too much risk in a single block. But the theory is that Exxon's board and management are more have more risk appetite, and as a result, they're okay with taking over the whole of Hess rather than letting Chevron nick it, because the Chevron price for Hess is arguably a steal, very much depending on obviously the oil price, because Guyana is very low break even, so you get enormous free cash flow numbers the higher the oil price, and that completely changes the value of Hess. And then of course the usual concerns, the biggest is, will Guyana change the PSC, which has always happened in the past, but it takes decades, so you know, it does seem to be a longer term risk, but not one that's going to happen short term. And then you've got this wild card of Maduro, which nobody's taking particularly seriously anymore, but which is out there. So what does that leave Hess and Chevron? We think they both want to do the deal. We think John Hess wants to sell to Chevron, so there's that. There's the possibility that Chevron pays Exxon, for example, offers them more than around 5% of the block, and therefore takes Exxon to 50%. That would be attractive. There's the possibility that they cut them a check and just say, can you go away, please? And there's the possibility that they go to arbitration, delay the deal, and then win the arbitration and do the deal, but you know, let's say a year delay. There's a little bit of controversy. Now the bankers tell me they know whether it's UK arbitration or London arbitration, but the merger people are not sure whether it's UK or US law, the one that I spoke to particularly. And if it's UK, that takes a couple of years. The reason it would be UK is potentially my old story about my father being the Deputy High Commissioner to Tanzania. Guyana historically was a British colony. It's a long story, but most recently a British colony. And as a result, British law might apply, which would delay the arbitration. Or it's US law, which is much quicker. But the bottom line is that maybe Chevron just says, okay, we'll go to arbitration, and they just take their time over the deal. They're long-term thinkers. Why rush this? It's a multi-decade asset. Or do they say, look, we've got to get this deal done, we want to get it out of the way and clear everything up. Exxon, what do you want? And they concede. Or in the process of delaying the deal, Exxon comes in over the top with a sweetened bid, and that's what's beginning to be discounted in the Hess share price. Now, why doesn't Exxon just do that immediately? As they can't, because they're in the process of the Pioneer deal, so they're not allowed to make a deal bid for Hess, which is why they're delaying. And that's why you end up with the theory that actually Exxon's delaying in order to make a counter bid for the whole of Hess. That's that. I'll leave it there. I've been going on a bit, but I hope you have a great week. Thanks.